Hi there, this is Ike Hoffman with Tactica Real Estate Solutions, and today I'm going to rank the 5 major return metrics featured in Tactica Pro Forma models. Those metrics are the internal rate of return, or IRR, cap rate, cash on cash return, yield on cost, and the equity multiple. I was recently asked about my favorite metric, and it got me thinking. If I was only able to choose one metric to use in every Tactica Pro Forma, which one would it be? For me, it's a no-brainer, and I'll share those thoughts with you today and give you my rationale. I also plan to publish more videos covering each of the 5 metrics in greater detail and elaborate on some of the points I'm making in this video. So check the description for links. If you don't see them yet, please know that they're coming. I'm going to start with the lowest ranked metric and work my way up to the best, or number 1. If you've been enjoying Tactica's real estate and analysis content, I'd really appreciate if you'd like the video, subscribe to our channel, and allow us to notify you when we're releasing new video content. Let's reveal Tactica's rankings. Coming in at number 5 and in last place is the cap rate. This might be surprising to some. It's the most frequently stated metric between industry professionals when discussing real estate investment, and it's the most common way to benchmark a property. The calculation takes the property's net operating income and divides it by the purchase price. If we take a look at Tactica's free multifamily analysis template, which by the way is linked below if you need an underwriting tool, we can make that calculation relatively easily. So let's focus on the T12 column. We're going to take the NOI after reserves and divide it by the purchase price of $7.8 million, and we get a 4.99% cap rate. We can also run a cap rate calculation on the T3, T12 financials. So in this set of historical financials, we're taking the last 3 months and annualizing it to get a more recent revenue trend. I'm going to copy and paste that formula, and since the revenue is trending up slightly from $946,000 to $955,000, our cap rate is a little bit higher because our numerator of the cap rate equation is higher, so a 5.11% cap. We can even go a step further and run that cap rate calculation on our projected year 1 pro forma NOI, so the $454,000 here. I'm going to copy and paste the formula. And once we're able to raise rents, cut down on some expenses, the cap rate increases to 5.82%. So let's talk about why I don't love the cap rate calculation. There's a lot of ambiguity baked into the cap rate. As an example, there's a ton of judgment calls that need to be made with how property taxes are handled, non-recurring revenue. So are non-recurring revenue items taken out and adjusted? What about non-recurring expense items? Have those been accounted for? And then the economic vacancy levels. Occupancy, for example, is constantly changing at the property. It would be very easy to cherry pick data when the property is exhibiting better occupancy numbers, which would lead to a higher NOI and therefore a higher cap rate. So there's just a ton of investigation that needs to take place in the weeds of the financials to make sure that we're getting the most accurate NOI possible. There's also the issue of buyer motivations. Believe it or not, a lot of people are not buying real estate for strictly yield and cash flow. A lot of them have maybe a tax motivation, such as a 1031 exchange, or looking for depreciation. If you're competing with somebody as a buyer that has motivations beyond yield, they're going to be able to outbid you, and that would be reflected in a lower cap rate. There's also the question of debt. Different investors are going to have different risk thresholds. Some will want more leverage. Some may want a longer amortization term, an interest-only period. Some investors might structure the deal with multiple financing tranches. Debt is not included in the cap rate calculation, and a group that has better capital network connections could be more aggressive on their bids, therefore driving down the cap rate. And finally, there's the question of CapEx. If a deal has a lot of deferred capital, a cap rate is essentially worthless because the cap rate calculation does not factor in any CapEx at all. As an example, if a property has a $50,000 NOI and it's priced at $1 million, is it really a 5% cap if it needs $500,000 in deferred capital? I would argue it's not. So cap rates are really just a benchmark, but one quoted cap rate on its own doesn't mean a whole lot. If somebody came up to me and said, oh, I'm getting this deal for a 7 cap, that means nothing to me. I would need to ask about 50 follow-up questions to start to determine if a 7 cap is in fact a good or a bad deal. Getting value from cap rates is much easier if you have vast comp data for the market that you're interested in, and you can reference and analyze all of those cap rates and start to gain a better feel for how your project is situated in the overall market. Coming in at number 4 is the equity multiple. The equity multiple is a total return metric that summarizes profitability. The calculation takes the total distributions that are paid out during your investment hold and divides it by your total contribution, so how much cash you put into the deal. It's a simple metric to understand, and it encompasses every cent flowing in and out of the project. Distributions can be in the form of cash flow, refinance proceeds, or sale proceeds. If we go into Tactica's free template model, you can see that we summarize the equity multiple in row 69. And let's focus on the equity multiple in year 5, so in column K. And let's go ahead and make a manual calculation just to show you how it works. So if we come down here, we'll say equity multiple in year 5. And first, let's just collect all the cash flow that we received during the 5-year hold, and then we'll collect the sale proceeds. So the cash flow, we would just come up equals sum and we'll come up and grab all of the cash flow after debt through year 5. And then in year 5, there were about $3.6 million in sale proceeds, and we can add all that together. And then the equity contribution was $2,060,000, and then the equity multiple in year 5 would just be the total cash flow and sales proceeds divided by the equity contribution. Remove some decimals, 2.11, which is what the model is calculating in year 5. But there's some areas where the equity multiple comes up short. If I told you your equity multiple is 2, would you be happy with that? At first thought, a 2 equity multiple means you doubled your cash. That might be good. But if it took 20 years to accomplish that, there were likely better investments you could have made that would have compounded your wealth faster. Another added bonus of the equity multiple is it's very easy to convert to an annualized rate of return. To do that, you just take the equity multiple minus 1 and divide it by the number of years you held the investment. This can help give some clarity to the question of timing. If we go back and revisit our 2x equity multiple scenario that took 20 years to accomplish, if we convert it to an annualized rate of return, you can see that really the annualized return was only 5%. So while the equity multiple, it lacks some sophistication, it doesn't account for time value of money, but it is an incredibly simple metric and it's easy to understand. Did you profit? And by how much did you profit? That can go a long ways, especially when you're convincing potential investment partners that maybe aren't on board with all the trendy, complicated jargon that gets thrown around in commercial real estate this day and age. Coming in at number 3 is the IRR, or the internal rate of return. IRR is the trendiest metric out there. Like the equity multiple, it's a total return metric and it accounts for every dollar flowing in and out of the project. It's also presented intuitively on an annualized basis. But unlike the equity multiple, the IRR factors in the time value of money. Earlier cash flow is more valuable than later cash flows. It's a great metric for comparing different projects, and it tends to be the industry standard in more sophisticated ownership groups. But there is a massive weakness. It is very easy to manipulate. Let's look at Tactica's redevelopment model quickly. So in the project level metrics, I have a $14 million purchase price, a 10-year holding period, and we're doing a fairly significant renovation on a distressed project. And you can see the leveraged IRR right now is 13.36%. This doesn't feel like enough return for how risky this project actually is. However, there's 2 different assumptions I'm going to play with just to show you how easy it is to inflate this leveraged IRR calculation. The first one is the refinance metrics. If we come to the refi and instead we say, instead of projecting a 5.5% refinance cap rate, let's be a little more aggressive and use a 5 cap. And then we come to our residual cap rate, where today we're projecting that this stabilized project could sell at a 5 cap, and then we're increasing that at an increment of 10 basis points a year. So in year 10, we're saying we're going to sell this at a 6% residual cap rate. If we instead come in here and turn that to 0, so now we're selling at a 5 cap in year 10, leverage IRR jumped up from 13% all the way to 19.36%. That's a massive difference for changing just 2 small assumptions in the pro forma. If we were sponsoring this deal with investment partners, if we had an IRR waterfall with different IRR thresholds stipulated. So in this instance, the first hurdle would be 8%, the second one 15%. Now, since we've made those changes, the IRR gets to 19% and we get into that third hurdle with relative ease. And in theory, all investors should be happy. But this is a very dangerous model right now because we are relying on the capital markets and really macro events outside of our control, the cap rates, coming down from our initial projections to inflate numbers and hit these return parameters stipulated in the IRR waterfall model. The biggest flaw with the IRR is it can be easy to forget about the basics, just how much cash flow do you have coming in, and is it adequate to cover your debt service each month? And it's easy to overanalyze major cash events and give too much credit to the refinance and sales proceeds. Small changes in pro forma inputs and timing can have a drastic impact on the projected IRR. It's also an incredibly complicated formula that, thanks to Microsoft Excel, seems simple thanks to the intuitive nature of just being able to click equals IRR and grabbing your cash flows with your mouse. I think the IRR is best utilized if you're the market expert and you're underwriting a significant amount of deals in that given submarket. You also need to have standard and strict underwriting procedures and be incredibly disciplined. If you can compare IRRs across many different properties you've been underwriting, you're going to get a better feel for the good deals versus the bad deals. So in summary, I think the IRR is a great tool to intuitively analyze multiple investments and gain a feel for investment performance. But it does put a ton of weight on macro level assumptions and can cloud judgment on annual cash flow and DSCR levels. It is the preferred metric of more sophisticated, volume-based buyers and sellers. But if you're not looking at tons of different deals month in, month out, I think there's other metrics that should be focused on more than the IRR, and I'm going to get into those next. Coming in at number 2 is the cash-on-cash return. The cash-on-cash return is the most functional metric for cash flow sensitive investors. Unlike the equity multiple and IRR, it's a yield metric and it doesn't factor in any appreciation. I think a well-vetted cash-on-cash return is arguably the best barometer of investment success. The calculation takes the annual cash flow divided by the total cash invested in the project. The annual cash flow is just the cash flow after debt service, and the cash investment is essentially your down payment you'd make when closing on the deal, plus any closing costs and any capex you're funding out of your own wallet. Let's go back into Tactica's free multifamily template. You can see row 72 is dedicated to calculating the cash-on-cash return. So what happens here is there are some hidden cells where the Tactica template stores the denominator of the cash-on-cash equation. So in row 74, the leveraged basis is essentially it's just the cash that's going in to the deal in year 0. And that stays the same throughout the entire hold because we never have any capex that we're funding out of pocket. So if we want to calculate the cash on cash on our own, let's do cash on cash year 1. We would take the cash flow after debt service divided by the denominator in year 1, get a percentage, 6.19%. Now, just for fun, let's assume we don't have any capex in the model right now, but let's assume that there's a $40,000 capex expense that we pay with cash flow in year 2. Say minus 40,000. So now what we would need to do is we need to adjust the denominator to include that $40,000 in capex. So I'm going to take the cash we initially put into the deal and then include the $40,000 on top of it. So it gets up to $2,098,500. So that's our new denominator. And then for our cash flow, we would take our cash flow after debt service, which is $105,599. But then we need to subtract out that $40,000, which gets us to 146,600. And then we'd just take that, the cash flow divided by our new denominator. We get a cash on cash return of 6.99%. What's nice about the cash on cash return is there's no need to speculate on things out of your control, such as a residual cap rate that's highly dependent on the capital markets, interest rates, what the Fed's doing. None of that matters in the cash on cash world. The cash on cash return is truly the best barometer to measure cash flow. It'd be very hard to fail in a real estate project with healthy cash flow and ample reserves. The cash on cash return does come up short in capital intensive projects that are short term in nature and dependent on appreciation. This could be a merchant developer, building a building and selling it immediately at stabilization, or a redevelopment project, or just generally fix and flip projects. Another area comes up a little short. It's not as great for benchmarking due to unique debt assumptions. I consider it a self-centered metric. It doesn't matter what other investors are doing. Only your preferences count. It's up to you to determine what's a worthwhile cash on cash return and figure out how to get there, either by paying less, finding more creative financing terms, or just finding a project that is priced more reasonably. Arguably, the cash on cash metric is the best metric to assess investment performance that doesn't require speculation on macroeconomic factors outside of your control. And coming in at number 1, drum roll please. Actually, my video editing skills aren't good enough yet, but they will be soon. It is the yield on cost. It is the most versatile metric out there. There's a ton of different terminology that refers to the same thing. You may hear the yield on cost referred to as the YOC, the return on cost, or the ROC, the development yield, or the net yield. This metric can be used on all project types. Stabilized deals, development, redevelopment, fix and flip, it doesn't matter. The calculation takes the NOI divided by the purchase price plus CapEx. It's a total yield on total dollars spent, and it doesn't factor in any leverage. It's kind of a hybrid cap rate / cash on cash return. It's more insightful than the cap rate because it factors in CapEx. And it's still great for benchmarking, unlike the cash on cash, because it doesn't factor in unique financing terms. It will give you a sense of annual cash flow potential, appreciation potential, and it allows you to benchmark a project against the comps if you take the yield on cost and compare it to market cap rate intel. It's arguably the most important metric in multifamily development. In multifamily development, you take the NOI divided by the total construction cost, and it's imperative that the yield on cost is greater than the market cap rate. If it weren't, why would a developer develop at all? It's risky. They could just go buy that same property and cut out all of the development risk. It's equally as important in redevelopment deals. An investor would need to ensure that the stabilized NOI divided by the purchase price of the property plus construction costs is greater than the market cap rate. The greater the spread between the yield on cost and the market cap rate, the more profitability potential. It's even useful in more granular project components. We can look at individual renovation plans. So taking the projected budget for how much it may cost to renovate, say, a 1-bedroom unit, look at the premium potential. So maybe a 1-bedroom unit needing a $12,000 renovation could justify a $150 rental premium. If we annualize that $150 and divide it by the $12,000 construction cost, we get a return on cost of 15%. You can then take that individual return on cost, compare it to the total project IRR. If that individual return on cost is higher, it's very likely that it will drag up the overall project metrics. The yield on cost is the most versatile metric and can be used in many different investment business plans and acts as a hybrid cash flow prognosticator and appreciation upside if you're verifying it against comp data. I have 2 separate videos covering the yield on cost in full. They're linked down below. So that wraps up the rankings. My rankings from worst to best are cap rate, equity multiple, IRR, cash on cash return, yield on cost. If I had to choose one and discard everything else for the rest of my career, I would choose the yield on cost due to its versatility and benchmarking. But thankfully, I don't need to choose, and I can look at all 5 metrics when making an investment hypothesis. All metrics have a unique purpose and should be used in tandem. And as a reminder, I'm going to be posting video links that cover all 5 of these metrics in much greater detail than I covered in this video. Hopefully you can take away some of the strengths and weaknesses of the 5 metrics we covered today and start incorporating them into your investment analysis. If you've been enjoying Tacticus real estate analysis content, I'd really appreciate it if you'd like the video, subscribed, and turned on your notifications. We'll catch you next video. Take care.